All right, students, this is our last lecture of the year here. We're going to cover Chapter 13, which we already started last time with a couple of these things here. So last week's material here, we covered the earnings per share, which is a profitability metric, simply as a net income divided by number of shares outstanding. It's always expressed as a dollars per share number. The other one is a market value indicator, price to earnings ratio. If you recall, that is simply the current market price per share of one share of stock divided by earnings per share. So since this is dollars per share divided by dollars per share, there's no units, and the PE is just a ratio. In other words, you might hear someone say the PE is currently 14.2. That's just a ratio, no dollars, but it tells you a lot about the relative price of the shares compared to their earnings. Very, very good measurement and a good indicator of whether to buy or sell a stock. All right, last material of the year. Here we go. Other ratios in the, when you look at financial statements, you want to look at various solvency ratios. So if you look at the debt ratio, this is simply the amount of debt for every dollar of assets that a company has. In other words, if the company was a $100,000 company and they had let's suppose $40,000 in liabilities, then you would simply say 40 divided by 100, you'd have a 40% debt ratio. It could be expressed as a percentage, like 40%, could be expressed as a decimal, as in 0.4. Okay, current ratio, very big and important indicator. It indicates a company's ability to cover their short-term liabilities. It's also known as working capital ratio or a banker's ratio. And what current ratio is simply current assets over current liabilities, usually expressed as a decimal, and you hope it's more than 1. If it's less than 1, that means you've got more dollars that are coming due or more liabilities that you're going to have to pay in the next year than you have current assets right now that you can pay it off with. So notice current assets includes anything that's close to liquid or already liquid, like cash. Receivables, in most cases, will be converted to cash within a year or one accounting cycle. Inventory, in most cases, can be converted to cash. And so cash, receivables, short-term investments, anything else that is more liquid than inventory would be included in the current assets. Okay, some balance sheets break that up for you, some do not. So you have to be aware of everything that's more liquid than inventory, and then you include inventory unless there was some reason you wouldn't. Some companies have, if you're a real estate company, your inventory may not be sellable within a year or so. All right. Liabilities is every liability due within a year or sooner, or one accounting cycle or less. And keep in mind that even if you have long-term debt, like bonds, or if you have a long-term loan or a note payable, companies do have to take out the portion of that note that is due within a year or less and call it a short-term liability or a current liability, even though the rest of the note, the rest of the bond, whatever the liability is, that may not be due within 1 year, but they always pull out the portion that is. Okay? Quick ratio is an even shorter term liquidity measurement because they simply don't count the inventory anymore. What happens is you just look at receivables, cash, and equivalents. This would include short-term investments, treasury bills, the types of things that companies invest in with their cash reserves, so that it's actually earning some interest for them. So anything that is receivables or more liquid than that, you would count as your quick assets. Notice that this has to be a smaller number than your current assets, because your inventory is going to be a positive number. You can't have negative inventory. So if you take inventory out, this number has to be smaller. Therefore, this ratio has to be lower than the current ratio. Okay, so current ratio, most companies would like to see something in the order of 2.0. That's not very realistic. Okay, there are some companies that have a current ratio of less than 1.0, which means you can't cover your debts in the short term. You're very, very thin. You're running very, very lean and could be bankrupt if you're not careful. Quick ratio is a slightly different ratio. It looks at just the stuff that can be liquidated very, very soon or is already liquid, like cash and T-bills and short-term investments. So this is a smaller ratio, and that's because the numerator, the quick assets, has to be a smaller number than the current assets for the same time for the same company. Okay, has to be. All right, so there's 3 different indicators you'll want to be aware of. Okay, another one is accounts receivable analysis. In other words, this compares your total credit sales to your accounts receivable, and what you're going to call it is accounts receivable turnover. I may abbreviate this as ARTO, accounts receivable turnover, and it's simply equal to the net credit sales, which you have to be given. I've never seen an accounting problem that doesn't give that to you, divided by the average net accounts receivable. Well, net accounts receivable is simply what shows up on the balance sheet in most cases. It's the total accounts receivable minus the allowance for doubtful accounts. If you remember way back in chapter 7, I think it was, when we covered that, that's net receivables. In most cases, that'll just be given to you. For big companies, they only put the net receivables on the balance sheet. They don't put the gross and the ADA and have you subtract them. Okay, rarely do you see that. So how do we get average net accounts receivable? Well, simple. It's the average for the year, so you simply take the beginning balance of the net receivables plus the end balance at the end of the year and divide by 2. So what's going to happen here is if you have 2 years of data, you know that the end balance from the previous year is the beginning balance of the next year. So if you have 2 years of data, you simply have to take the end balance from the previous year, understand that that is the beginning balance of the next year, and then you get the end balance of the current year, and you average these two. So add them up, divide by 2. That is the bottom of the fraction for your ARTO. You have to be given net credit sales. You divide this average into it, and there you go. Okay. Next one's called inventory turnover. All right. This is a comparison of the volume of goods sold to the amount of inventory carried. Okay. If you cycle through your whole inventory 10 times a year, then your inventory turnover is going to be close to 10. Okay. And by the way, these two will simply be a ratio. Like accounts receivable, that's how quickly you cycle your accounts receivable. If you're a retailer and you bill things every 30 days, your accounts receivable turnover might be close to 10 or 12x because you're hoping to get those things all paid off every month. So 12x would mean 12 times in a year. All right, inventory turnover depends on the company. You'll see these range widely depending on the type of inventory. Okay, if you're a grocer like a Raley's or a Whole Foods Market, you would hope this is pretty quick because you do not want to keep food on the shelf very long. Okay, if you're the seller of something that's not perishable like food, I suppose this could be longer. All right, if you're a retailer, if you're selling clothes like a Nordstrom's or a Macy's, you would think that this inventory turnover ratio would be, I think, 4 or 5 or higher because you have 4 seasons. You hope you're going to sell out all your inventory, at least that much. And even if you don't sell it, you at least send it off to the outlet stores and get rid of it or sell it wholesale or at deep discounts. Okay, so very similar calculation. Instead of net credit sales on top, you take the cost of goods sold. Okay, so that's the cost of all your outgoing inventory, not the retail price, the cost to you, divide by average inventory. Just like we said a moment ago, your average inventory is going to be your beginning balance inventory plus the end balance inventory for any given year. Oh, and keep in mind, the beginning balance inventory is going to be the end balance inventory from the previous year. So if you're given 2 years of data, you can do this. Take the end balance from the previous year, that's the beginning balance this year, plus the end balance this year, divide by 2, and you've got the bottom of this fraction, average inventory for the year. Divide that into COGS, and you should get a positive number, hopefully between 2 and 12, 2 and 14, and it'll be 14x or 12.5x or 11.2x. And that tells you you're cycling through your whole inventory about 11 times a year. Very good measurement of inventory management and very, very helpful. Okay, now we're going to take a break here and you are going to go to the website there, and right below this lecture you'll find a handout called Coke and Pepsi 1993-94. It's old data. It's very revealing about these two companies. What you're going to do is you're going to look at all the data on that sheet and you're going to calculate the 5 ratios we just covered in this last 15-minute lecture, and you're going to calculate each of those 5 ratios for each company. Write them up, show your calcs, and keep them in an organized fashion so you can just line them up right next to each other. Accounts receivable turnover for Coke and Pepsi, inventory turnover for Coke and Pepsi. The other ones were debt ratio, current ratio, and quick ratio. So you want to do those 5 ratios for Coke and Pepsi once you have printed this handout here. Okay, so I'm going to stop the lecture here and we're going to let you go do that. Come back when you're done with that.